Hi guys, welcome to my channel KP Financial and Strategy Review. Myself Praveen Kumar. In today's video, I will be discussing important red flags and indicators available to understand and review whether there is any possibility for occurrence of frauds and errors in entity. We would like to discuss in detail. Before proceeding further, I suggest each and everyone to watch part 1 of this video. Therein we have discussed about what do you mean by fraud and what do you mean by an error, what is the meaning and differentiation between these two, and what are the reasons and the root causes for such occurrence of frauds and errors as a whole. We have discussed in detail. So I suggest each and everyone to watch part 1 to have a complete knowledge of this subject. Now coming to part 2, in this video I will be discussing important red flags and the indicators. Based on my knowledge and based on the information I have and based on the research I have conducted, there are more than 100 indicators available to alert you whether there is any possibility for frauds and errors in an entity. But due to timelines, here I am giving only top 10 or 20 indicators so that you can directly relate wherever it is applicable to you. Number 1, unusual transactions. If you see the financial performance of an entity in terms of, say for example, say from P&L point of view, it includes sales and expenses and profitability, losses, etc. And if you see current month performances versus last month, comparing current quarter versus last quarter, comparing current month this particular period versus last year same month period, comparing actual versus budget, comparing actual versus standard. In such cases, if there is definitely there will be variances. If there is no variances, then is one of the indicators of red flag. There will be variances, there should be variances, but if that variances are within the reasonable limit of 5 to 10%, then that looks reasonable. But if that is beyond our reasonable limits or beyond the actual business scenario, in such cases you need to look into whether there is any possibility for red flags and indicators. That is one. Number 2, high employee turnover, not sales turnover, employee turnover. See, in an entity, employees throughout the financial period, employees will come and go. There will be in and out of an employees. That is a regular practice. But in any particular department, if there is an excessive turnover beyond a reasonable limit, in such cases, that also indicates a high red flag to know what could be the reason for such employees are leaving so frequently in a particular department. That could be the one of the indicator. And number 3, inadequate segregation of duties. Inadequate segregation of duties, nothing but the same person is performing a couple of roles. Like the same person is, if you see from sales point of view, same person is doing sales invoices, sales quotations, sales order, purchase order, everything same person is doing. If you see from purchase point of view, same person himself is preparing purchase requisition, same person is preparing purchase order, same person is approving and confirming. That is also one of the indicator. Next, frequent change in the auditors or legal team or finance team also. See, frequent change in the finance team, frequent change in the legal team, frequent change in the auditors, generally that also indicates a red flag. You should be alert. And excessive use of manual journal entries. See, in the present scenario, in the present business practices, every company generally they will having a standard ERP, and each and every cycle, either from purchase, sales, or ERP, logistics, HR, each and everyone has their own modules, and they will follow as per the process workflow. And in accounting point of view, they will be having a sales module, purchase module, inventory module, treasury module, etc., fixed assets module, etc. And rather than following this particular module, if you are using a lot of manual journal entries, once in a while at month ending, year ending is okay to adjust the entries, but using as a regular practice regularly, then that indicates for possibility for frauds and errors. You should be careful. Next, unusual patterns in the financial ratios. Financial ratios means, as I told you, top 10 financial ratios generally categorized into 4 parts: profitability, liquidity, and efficiency, and as well as entities solvent position. And in those ratios, if there is any inconsistency in the patterns, then in such cases that is also one of the indicator. Next, inconsistency, revenue recognition. If there is a frequent change in the revenue recognition principles and policy of an entity, could be case to case basis also, but even then indicators are, this is one of the indicator. Inadequate documentation, very very important. People are not maintaining proper documentation. Everything is happening, communication is happening through phone calls, either mobile or landline, or through WhatsApp messages or Telegram messages, and there is no proper mail documentation, and there is no proper hard copy documentation, soft or hard copies. and everything is happening through just through phone calls, through messages. In such cases also, or whenever you are asking certain information, there is no proper documentation readily available, indicators of frauds and errors, and reluctant to provide information. When you are asking information, other person is not providing the required information, or providing only partial, or is diluting the information, or is coloring the information with a different color, is trying to twist the information, or trying to change the intensity of the information, or is taking that is doubt we are doubting his ethics and integrities. In such cases also, red flags are available. That is one of the red flag. And next is high level updates. Entity due to tax saving reasons or any other financial capital structure reasons, if they are taking high level updates, that is one of the indicators. Next, over reliance on a single customer or single supplier, very important. Always relying on one particular customer, or two group of customers, or one particular supplier, could be any reason. Why? Because your material might be customized to one particular group of people, or your supplier might be original manufacturing supplier or original service provider. Because of that, you are depending on him completely. You can depend, not a problem, but over relying on only one particular customer, particular supplier, will indicate that if something goes wrong at their level, and your entity has to stop your operations and have a problem for existence of an organization also, it is not a good deal. And further, there could be possibility for corruption, and as well as there could be possible for negotiation deals with the customers and suppliers accordingly. So you should be very careful. Next, declining market share. See, market share will decline for many reasons, but in certain cases, even though there is nothing has happened in the entity, generally everything is good, but even then market share is declining means could be negative news or negative spread, or loss of customer trust, or sentiments, or change in the sentiments of the shareholders and the stakeholders in the market, that we need to check. Next, overstatement of assets, understatement of liabilities. There could be possibility that to show the financial performance and financial position, it's very good, and to take in kind of loans, or to have a good image in front of expected shareholders or expected stakeholders. Due to any reason, there could be possibility for overstatement of assets and understatement of liabilities by overriding the applicable accounting standards and principles. Then in such cases, that is one of the indicator. Ineffective internal controls, one indicator. There are no controls, or even though there is a control, there is no proper effectiveness, no monitoring, or even though there is a monitoring and effectiveness, some management team can override the controls. This is also one of the indicator. Next, poor corporate governance. See, in an entity, generally if you go from private limited companies or family owned businesses, the shareholders and the management and the board, everything will be same generally. And if you go for listed companies or big companies, generally the shareholders generally will not participate into the day-to-day operations of the company. So there is an agency relationship between the management, board, and the shareholder. There are three different parties. In such cases, each and everyone has to work in the to protect the best interest of the shareholders ultimately. So are they doing that? Are they performing? How they are performing? How is the composition of the management and board? All this should be strong and effective. So that is one of the indicator. If there is any loopholes. And conflicts of interest is nothing but see, the relationship between an employer and employee should be purely employee-employee relationship. The employee should not become a debtor and the creditor to the business. He cannot lend beyond certain reasonable limits, and as well as he cannot take loans and advances from entity regularly unreasonably beyond certain limits, or so close relatives or family members, or within the same company, within the same department, other department also. So in such cases also, existence of frauds and errors. And not only for existence of frauds and errors, even though there is no frauds and errors also, but it will affect the effectiveness and performance of the particular unit or company as a whole, due to these conflicts of interest and objectivity. So you should be careful. And aggressive accounting policies and practices. See, as per accounting principles and accounting standard, either US GAAP or IFRS, Ind AS, whatever may be, all accounting policies generally are conservative principles only, not aggressive principles. So if there is any following aggressive principles, like recognizing revenue when it is not required to be, when it is generally it is not required to be, but you are trying to book a revenue and expenses accordingly to overstate assets and liabilities, that is one of the reason. And not, next is inadequate or delayed information, not providing information on time, or providing wrong information, or hiding the information, or reducing the changing the color of the information, that's also one of the indicators. Next is finally unexplained variances in the budgets. Always there will be a difference between actuals and budgets. If there is no difference, there is one, then that zero difference is a red flag. There should be difference, but the difference should be within the reasonable limits, and even though if it is not in the reasonable limits, there should be a proper reason and the causes for that. If the other person is not able to provide a proper reason and explanation whenever is required, then in such cases that is also one of the important red flag and indicators to know and note whether to know and understand whether there is a possibility for frauds and errors. So these are the common indicators. Beyond this, there are a lot of other indicators also. We'll discuss in the next topics going forward. Thank you very much. Stay tuned. Thank you for watching this video, and I request each and everyone to subscribe, like and share to the relevant people so that it can reach to many relevant persons. Thank you very much.